We're joined now by Koketso Mano, an economist with FNB. Koketso, thank you very much for your time as always. How significant is a 0.1 percentage point increase in inflation that we've recorded in August? Because for some, this could mean something paltry, really. But from your side, how significant is it?
Yeah, I think one thing to mention is that it was broadly expected. So it is significant in the sense that we are seeing your utilities, your municipal utilities being surveyed in July and August. So we had that data trickling in over the 2 months, and seemingly, especially when you look at water and other services, those prices are really increasing quite strongly, now sitting at 7.9% inflation. We're also seeing electricity inflation at 15.1%, which is in line with the NERSA guidance to municipalities. So from that sense, you are seeing high utility costs that are going to add the pinch to consumer budgets. And on top of that, we still see food inflation remaining relatively elevated. It has come off, which is encouraging to us, but it's still 8.8%, well above, the inflation target band. And then, so when you think about all of those things put together, it's seemingly that, the consumer is not yet out of the woods. Food inflation has lifted 2.2% on a month-on-month basis. So we are starting to see that pressure coming through, and it's a pressure that is concerning at a global level as well. So yeah, so from that perspective, it's only a 0.1% increase to 4.8%. However, we continue to see or predict further increases in the coming months.
Let's stay with food, Koketso, because that makes up at least 15.3% of the inflation basket, which was up 8.2%. This is still highlighting the difficulties faced by consumers, especially as stable foods such as bread and cereals were up 9.9%, and as others like milk and cheese were up 11.9%.
Yeah, so yeah, those staples are still showing you some pressure. You can include their vegetables as well, also remaining relatively elevated, especially on a month-on-month basis. We're still seeing that pressure. I guess the positivity to pick up from the data is that meat inflation is on a month-on-month basis in deflation. So meat prices rather are in deflation in August. So that would be something that indicates to consumers that on aggregate, when you go to your grocery store, you will see meat prices falling relative to the previous month. And even on a year-on-year basis, we're still seeing quite muted meat inflation. So on a balance, your staples are rising and we're still seeing that pressure, but at least you can also now start to look into purchasing with relatively more ease when you think about your proteins. So that's something that we need to think about in balance. On a month-on-month basis in total, we saw no pressure in food and non-alcoholic beverages inflation. Once again, I think just to pull out some of the positives from the data, not just sticking to the negatives.
No, absolutely. And investments, Koketso, is one thing we seldom talk about when it comes to inflation. And I'm talking about it now because there is exposure to inflation-linked bonds as well. They are looking at this because there's insurance against a possible surprise to inflation as well.
Yes, but as we said, this was not a surprise, shouldn't have been a surprise to the market. In fact, even the increases that we expect to come over the next couple of months, in general, the disinflation trend in inflation is expected to be choppy. So that's something that we've communicated quite effectively, and we think that the market should be expecting this. When you speak about risks, however, I think the risks are mostly emanating from your fuel category. We are seeing higher Brent crude oil prices, and some expectations are that those prices could rise to about 100 or just over 100 before the end of the year. So in terms of risks, I believe that's where most of the risks are coming from. If you think about core inflation and the general pass-through of these higher or the lift in fuel prices, we think that the consumer is quite constrained at the moment. I'd like to speak to, unemployment on aggregate, still being lower than 2019 levels. Salaries have not been able to keep up with inflation. We saw in the GDP numbers 5% quote-unquote inflation, quote-unquote wage growth versus 6.2% inflation. So the consumer is quite constrained. So the ability for producers to fully pass through these input cost increases is probably going to be limited, which is probably what the MPC wanted to achieve. So in terms of risks, yes, we do see upside risk to inflation, but this number was broadly as expected.
Tomorrow, it's a big day. The South African Reserve Bank and Monetary Policy Committee is announcing its decision on whether we are going to pay more for our debt and credit. How much of the latest inflation print will influence their decision? And what is FNB's forecast for tomorrow's decision on the repo rate?
Sure. So inflation at 4.8%, still quite close to the midpoint. What I think is more important is that when you look at the MPC's previous forecast, which was published in the July meeting, the second quarter starting point was higher than what we currently have. And that's simply because of those strong positive base effects that we've had over the past couple of months that have supported inflation lower. So from that perspective, the MPC is still dealing with lower inflation relative to what they expected at the previous meeting. Now, I think what the MPC will try to process is how these fuel price increases will impact inflation and how enduring they may be as a concern to them. But on balance, we think that the MPC will keep the interest rates unchanged tomorrow. Probably all of these upside risks give them more of a reason to keep interest rates at current levels for a little bit longer. So we expect interest rates to remain in this restrictive territory as they've characterized it, at least for the next couple of quarters before we start speaking about cutting interest rates maybe in the middle of next year. And maybe just to expand on why we expect restrictive interest rates to prevail for a little bit longer. Besides the inflation outcomes, we're still also dealing with funding vulnerabilities. You would have heard already that the fiscal position may not be as strong as we expected at the beginning of the year, at the budget. And on top of that, you also have adverse risk sentiment. And, we're thinking that those funding risks are probably going to keep the MPC also on edge. And as a result, keeping interest rates at current levels, at least until the middle of next year, after the elections and potentially after, so that currency or negative currency risks.
And I was going to ask you about that because some analysts have speculated that the Reserve Bank is close to the top of its interest rate hiking cycle. But I wouldn't be correct from what you've said to also speculate that the continued hawkish stance most likely means that the first rate hike is still some time away and maybe in the third quarter of next year, which is talking to what you were saying, that we might see it somewhere after the elections next year.
Exactly. So that's our expectation. I do realize that some analysts are seeing cuts as early as the beginning of next year, but we have considered all of these risks and upside risks to be exact, to be some of the reasons why the MPC may want to hold off on that, keeping interest rates higher for longer. And I mean, just to expand, this is something that we're seeing globally, right? It's not just a South African story. We know that the Fed has probably also reached the top of its hiking cycle. Some market expectations are for another hike in November, but we wait to see what they say today to get some indications. But in general, as I said, you probably have upside risk when you think about global energy costs. So that's something that's probably going to keep, monetary policy a little bit more reserved, concerned more about upside risk to inflation rather than, moving quickly to support the economy without making sure that inflation is, or that the trend in inflation is insulated enough to get back to target. We think that's going to happen in the United States, for example, and we also think that's going to happen in South Africa as well.
Okay, so you've spoken about the outlook and the fact that you as FNB expect that inflation will tick up in the coming months. But when I looked at your forecast of 5.5% for September, it's quite alarming, and it means that this is going to keep us in these vulnerable times for much longer. 5.5% is quite bold to actually stake out a state as a bank. But what are you seeing there besides electricity and particularly fuel as those big drivers next month?
Yeah, so I should reiterate, as you just mentioned, fuel is the biggest contributor there. But besides that, we're also seeing, we usually have those periodical surveys that SSA does in September around housing inflation. So there might be a bit of pressure from that perspective. If you think about the property market, which is probably a bit more tight now with households not being able to afford as easily as they would have been post-pandemic when interest rates were quite low. So you might see some households moving back into the rental market, and that should be something that supports those numbers that we're expecting in September. So just a few more outcomes that we think will probably lift core inflation. We also know that there's insurance, vehicle insurance surveys that we know that reinsurance has been an issue in the market for some time now, post-pandemic, and so there might be post-riots as well. So there might be some pressure coming through there. So besides fuel, food, we also see a bit more pressure on core inflation from those periodical surveys.
The high cost of living seems to be something that will be with us for some time to come. Koketso Mano is an economist with FNB. Thank you very much for your time.